Welcome to Stabilisation Finance. I'm Georgina, and this is the show where we explain how a finished building becomes a fully let one, in plain English, for developers, investors and operators. Today, we are setting the scene for 2026. What Stabilisation Finance is, how lenders size it, and the loan structures that carry an asset from practical completion through to a stabilised income. Let's start with the core idea, because it is the whole show in one sentence. A newly built, refurbished or recently let property is worth far less on the day it completes than it will be once it is fully let and trading. The gap between those 2 points is the stabilisation window, and Stabilisation Finance is the short-dated debt that carries the asset across it, then hands it over to a long-term lender or a sale. The crucial thing to understand is what a lender underwrites. They do not size the loan on today's income because at completion there often is not much. They size it on the path to stabilised income, the occupancy trajectory, the lettings plan, the debt yield and the interest cover the asset will reach once it is full. So the lettings plan and the occupancy curve are the underwriting, not just the bricks. Loan to value during lease-up is indicatively 65 to 75%, and a credible exit, a refinance onto a term loan or a sale, has to be there from day one. A quick word on us. Stabilisation. Finance is a broker and introducer, not a lender. We arrange and place this finance with the lenders that fund the gap. We never name individual lenders on the show. We talk about the camps, specialist real estate debt funds and bridging lenders for the short-dated pieces, challenger banks and senior investment lenders for the term debt, and mezzanine and preferred equity providers for the stretch. Now, the backdrop. The Bank of England base rate is 3.75%, held since the December 2025 cut. UK commercial real estate investment was around £62.8 billion in 2025 on CBRE numbers, with a strong fourth quarter. And the thing that turns a stabilised income into a stabilised value is the prime yield for the sector. On Knight Frank and Savills figures, prime yields sit around 5 to 5.25% for industrial and logistics, about 4.25% for prime build to rent, roughly 4.25 to 5.5% across student accommodation, and around 5% for self-storage. The lower the yield, the higher the value the same income supports, which is why the sector matters so much to the exit. Let's walk through the loan structures. First, Stabilisation Bridge Finance, the head product. Indicatively, 65 to 75% loan to value during lease-up, 12 to 24 months. Interest only or rolled up while occupancy builds, exiting onto a term loan or a sale. Second, Development Exit Finance, taken at practical completion to repay the development loan and buy time to sell or let, indicatively 70 to 75%, 6 to 18 months, priced below the development loan it replaces. Third, Bridge to Term Finance, where we arrange the long-term investment loan alongside the bridge, so the exit is built in from day one, with the term loan underwritten on the income the asset reaches, not today's. Fourth, Lease-up Finance, which funds the income ramp, sized on projected stabilised income. Lease-up looks different by sector. Build to rent might reach around 80% occupancy inside a year. Self-storage fills up over roughly 3 years. Student schemes let in an annual cycle. Fifth, refurbishment to stabilisation. One facility across the works and the lease-up that follows, with works funding up to 100% released in stages against a monitoring surveyor's certificates. Sixth, mezzanine and preferred equity, the stretch behind the senior debt and in front of developer equity, taking senior plus mezzanine indicatively up to 85 to 90% of cost, priced higher than the senior to reflect the risk. Seventh, cash out refinance, releasing equity once an asset has stabilised by refinancing onto a larger term loan against the revalued investment value, up to 70 to 75%, with the uplift returned to the owner. And eighth, the destination, senior investment term loans, 5 to 25 years, indicatively 65 to 75% of investment value, sized so net rental income covers debt service with headroom, priced as a margin over SONIA or base, or a fixed rate. One more theme: Stabilisation Finance is cross-asset class. Student accommodation, build-to-rent, self-storage, roadside and leisure, multi-unit residential and HMO portfolios all use the same structure. The income basis differs, room rates, unit rents, fill-up curves, but the shape of the deal is the same. If you want the detail, we have built a full set of guides covering each of these structures, and you can find them linked from this episode and at stabilisationfinance.co.uk. One important note before we finish. Everything in this episode is general market commentary, not advice and not a quote or an offer of finance. The figures are indicative and vary by lender, asset and scheme. We are not FCA authorised, and the lending we arrange is unregulated commercial lending, so do take professional advice for your own situation. That's our 2026 overview. I'm Georgina. This has been Stabilisation Finance, and we'll see you in the next episode.